Thanks for joining us. It's a great pleasure to have with us Michael Shearn, the managing partner of Compound Money Fund, a concentrated value fund based in Austin.
Yes.
Michael, welcome.
Thank you. Thank you for having me, Oliver.
Great to have you on the program. And the topic, of course, is investment checklists and the uses and misuses of checklists in investing. You've written a great book on the subject, The Investment Checklist, The Art of In-Depth Research. Before we get into that topic, tell us a bit about yourself and how you got interested in investing and checklists.
Well, you know, a lot like a lot of the people here at Berkshire Hathaway, I started reading Warren Buffett back in high school, and it exposed me to a new way of thinking about investing. And you know, that's kind of how I got a start, just reading, you know, what he had put out about 18 years ago. And then I started, you know, out of college, I couldn't get a job, so I started in the finance world, which is what I loved, and so I started working on my own, and from there built up time value of money in the Compound Money Fund. So.
Now, tell us a bit about how you got interested in the checklist approach, and of course, it's as value investors, it's all about doing fundamental research. Give us a sense of how you go about doing research.
Well, what happened is when I first started investing, I found that if a company put out a negative news release or the stock price dropped, I'd have a very bad, reaction to it. You know, and I'd be running around like Chicken Little, the cartoon character, thinking the sky was falling, and I didn't understand, you know, why. I just said, God, I got to stop having these reactions, you know, these negative reactions. And so what I started saying is the problem was that I didn't understand enough about the businesses that I was invested in, because I wasn't in a position to interpret the news events as they were coming out, or, you know, to determine whether it was, you know, a real issue or maybe just a temporary issue. So I started coming up with a series of questions that I would ask to increase my knowledge in a business, so that I'd be in a better position to understand, how to interpret these news events and understand more about the company. But it actually ended up being somewhat of a mistake, because, you know, I started doing this for a lot of years where I was just answering questions to answer questions. I did get to know more about the businesses that I was invested in, but the downside was that the amount of questions became cumbersome, and so in a way the checklist lacked a purpose. You know, I started asking, you know, what is this purpose of this thing? Is it just to answer questions? You know, I am learning more about the businesses, but what is the purpose? And so I started thinking about the purpose of investing. And it's really, the purpose of investing is to understand the value of whatever you're buying, right? So because if you understand value, you know when to buy, you know when to sell, or when to hold. But so I started thinking, well, these questions, you know, instead of increasing my knowledge of the business, should be more about understanding how to value the business. And so, you know, you need, in order to value a business, you need to know something about the stability of earnings, and more importantly, how those can change in the future. And so you got to ask questions, you know, about the company in order to understand, you know, be able to answer whether it's a stable earnings, or, you know, is this, and how they're going to change. Things like, you know, what kind of sales it makes. Is it recurring revenue? Or is it one-time sales like patio furniture? You know, what are the future growth opportunities? If as you go through these questions, you're actually learning that valuation is actually quite dynamic. You know, it's not static, it changes. You know, for example, depending on the type of business, if you change a management team, it's going to have a profound effect, you know, on the future earnings of the business. A case in point is JCPenney. You know, Ron Johnson, when he came in a very short period of time, succeeded in decreasing 25% of the sales at JCPenney. So a management change can have a very big effect on the future earnings of a business. So it's really about understanding, just looking at a business in a more holistic way. So that's the purpose of these questions, you know, asking questions about management, you know, what kind of management team you're partnered with, looking at it from the customer viewpoint, looking at it within the context of its industry, So for example, in the past I would spend too much time trying to determine if a business had a competitive advantage. And over time I started learning that actually the most value in a stock or investment comes from as a business is building its advantage, not after it already has one. And so a lot of the questions are centered around understanding if a business is in the process of building its advantage. Because you can think of Microsoft. The biggest gains came when Bill Gates was managing that business and building it, rather than now that it already is kind of a quasi-monopoly that already has an advantage. So really, that's one thing about the checklist, is it allows you to kind of look at a business from a multiple stakeholder, as you will, viewpoint, and better understand how value can change, if any of those factors changes.
And help us understand it on a practical level, and we'll get to the misuses of checklists, and you mentioned one or two already, but how do they then fit in your investment process on a practical level? Just give us a sense of the day-to-day of using checklists.
Well, we've started, using it to look for disconfirming information. Why not to be invested in a company? So rather than thinking about whether a balance of factors in a business, a positive factors will make up for the negatives, we're looking for that one weak link or, in the chain, that in order to pass on a business. So, my favorite example to use in that is one of the questions of the checklist is, are the products and services good for the business or for the customer? And we were analyzing Jackson Hewitt, which is a tax preparation company. And when I was very excited about it. It was a franchise business, high returns on capital, and it was an established tax preparation company, and seemed to have a lot of growth opportunities. And as we analyzed it more, we started learning that a large percentage of the profits would come from tax refund loans. This is where a customer goes into a tax preparer and they calculate the refund that's owed to them by the government, and they would lend them money at extremely high interest rates that they would then get paid back by the government. And when we analyzed this, we learned that these loans were only outstanding for about 2 weeks. Because refunds are actually processed a lot quicker by the government these days, and so they were taking advantage of their customer and basically customer ignorance. A lot of customers thought they would not receive their refunds until 2 to 3 months later, and it just became obvious to us that this is a business that takes advantage of its customers. And so, we avoided investment mistake because they actually ended up going bankrupt after the government kind of shared our view and started regulating these loans a lot more. We look at it to look for the weakest link as the most practical way to use it, rather than when I first started just kind of answering every question just to answer every question. Now, it will give you more knowledge of a business, but you need to understand what is it that you're really looking for. What is the disqualifying feature in this investment?
So you would, let's say you become interested in a company as an investment, comes up on a screen, or how do you even generate ideas then?
Well, what we've done is we're looking for our niche, I guess, is first-class management. And so we have a set of about 300 companies that we went through 8,000 companies kind of one by one. So we didn't screen, we just kind of went A to Z, looking for businesses or management teams that met our criteria. So for example, we would simply go to the website and go under the employment and look to see if they talked about culture. And on the website, they have, become an employee, and they would, you could see if a company had a robust culture by, they'd say, this is the culture of the business, this is who we're trying to hire. Or if you'd see a very generic, we provide competitive salary, 401k plan, that was a great insight into, and so great management teams to ours are those that build great cultures. And so, as we're going through this list, that's what we were really looking to identify, these first-class management teams. And we'd read their shareholder letters if there was one. It becomes more complicated if there's less. What we do is we use Factiva, which is basically a repository of historical articles about a business or management team, from the Wall Street Journal, Barron's, Economist, and we'll just search articles about the CEO of a business and just to kind of understand, who it is that we're partnering with. And we're looking for stories. There's always stories in these articles or interviews about what they find important, what they focus on. Are employees important to them? So we're looking for businesses where employee engagement is high. If you look at like a Gallup poll of employee engagement, 75% of employees are not engaged at work. They don't like going to work. That's why there's, thank God it's Friday attitude. And those businesses tend to create, in our opinion, create less value. So we're looking for these great management teams and these growing businesses that are creating these cultures. And so that's kind of how we start getting our list down. And then from there, we just kind of wait for some negative news event or something to happen where their stock price gets hit or decline, and then we'll buy. So we already kind of know what we want to buy and what we want to buy it at. So we do a lot of that.
And then so you form your view as to how to exploit that particular situation as an investor, and then you use the checklist to, let's say, question that investment thesis that you have as an assumption, let's say.
Well, like for example, I think the checklist, the best tool is that it enforces the application of every investment lesson you've learned or mistake, because it just reminds you again. So one of them on there is understanding a business from a customer viewpoint. And this one's the most difficult because you have to go out and talk to customers. But it's a very necessary step because using your own personal assumptions about a business, about your opinions, what you think is not the right way to analyze it because it may not be that way. You got to see it like, okay, this is a customer. They're using the product day to day. How do they think about this company? So I was analyzing Moody's, the bond ratings company, and I don't use Moody's, in my day-to-day life, but I started interviewing bond fund managers and various people that use Moody's, even pension fund advisors, whoever used it, and you get to see their perspective that, that this is something that's not going away, that they don't want an alternative, that, I ask them, what would your world look like if this business disappeared? Which is a great question to ask of any business because, if you think about it and you see it from the customer perspective and Moody's disappears tomorrow, you'd have a lot of chaos in the bond fund markets because you have S&P, but they don't rate every company out there. So you kind of learn, you can kind of see a competitive advantage, say, in a business quite quickly looking at it from that aspect. So the checklist is just very good about making sure that you're asking the questions and not forgetting, So for example, we look at Glassdoor a lot now, which is employee reviews of a company. And there are a lot of, random complaints about the company, but sometimes you get really good employee reviews and insights about what type of company it is. What is it like to work there? And so sometimes we forget to do that, to just go check Glassdoor, and on some of our, in fact, recently we forgot on an existing holding, we do it for all these other holdings, and we said, gosh, we haven't even done it on some of our existing holdings, and you can get some good insights from that. So it's just basically making sure that you're not forgetting things is the way I look at it. It's more just to bring things top of mind.
And when it comes to management, you do have a chapter in the book about how to interview the management team.
Yeah.
And how, give us a sense of, based on your experience and talking to lots of managements and thinking about how to ask the right questions.
Yeah.
What do you look to get out of a first meeting with the management?
Basically I want to know them. And so I don't ask questions that are, issues that they're dealing with now. So what I ask them to do is just kind of throw away the investor presentation. A lot of them have their, and just sit back and just walk me through their career. Like, how did you start? Like, what was your first job? And just walk me through, like, what happened after that? What happened after, and you can kind of see the experiences they've had in asking them that. So you're basically writing a biography. If you have an hour, and it's I find it way more useful than talking about the company, which there's a lot of information out there anyways. So I use it more to just kind of talk about them, and everybody's favorite subject is themselves, so, once people get talking about themselves, they keep going, and you can really learn about somebody, and it's fascinating to see the lessons they've learned or what they thought was important and it's not important, and the different positions they've had at a company. And what was that like? Did you like working in the corporate office, or are you more of a field person? So you can really get more insight through asking it, about kind of writing a biography about them rather than, asking them about the latest quarter's earnings or those kind of things.
Now, when do you say, enough is enough in terms of that research? And you alluded to that, perhaps one misuse of checklists to just answer questions for answering sake.
Yeah.
Help us understand, in terms of your research, whether it's researching and getting comfortable with management or any other aspect of it, when do you have enough of information that you can form a judgment and gain conviction on that judgment?
That's a really good question. It's never enough, right? You're always learning something new, but at some point, we look for first-class managers. Now, within that group, there's some that just stand out. That just you can look at Bruce Flatt, the CEO of Brookfield Asset Management, as an example, and you ask him what his hobby is, and it's collecting shares of Brookfield. He's never sold any shares. His lifestyle, we looked at his personal lifestyle, has not changed. He owns the same house he's had in New York, or same apartment, same one in Toronto. So money doesn't mean very much to him, yet he's worth $500 million. And you could look back at his decisions. One thing again with Factiva, you get a lot of articles, and how he acted in certain situations. So, on September 11th, when the Twin Towers fell, Brookfield Properties owned the 4 World Financial Center towers around that, and they were damaged. And what Bruce did is, the day he heard of it, he got in a car and got down to New York, and started managing from the field, basically figuring out what is going on with our buildings. They were saying they were structurally damaged in the news, and he went in there and checked it out for himself to see if they were. And then they had some subsidiaries that provided plywood and certain materials, and he had those shipped immediately so that they could get their tenants back up and running. So when you read stories like that, you kind of know you're dealing with a first-class manager, that just pop, to you. And it's rare when they do. The most difficult are those that are long tenured. They've been at the business for a long time. They weren't the founders. The founders are kind of easier to analyze. You look at, like the proxy statement, and there's a lot of indicators of who you're dealing with. But then the more difficult ones are, again, these people who've been at the business for a long period of time. So what we're looking for is making sure, for example, integrity is very important. And it's so easy to say, oh, I want to find somebody with integrity. Well, the only way you're going to know if somebody has integrity is if their character's been tested, and what did they do in a difficult time? That's the only way. And so one of the questions on that checklist is, define a moment of integrity, because you really can't say, I can't just have a gut reaction and meet somebody and think they have integrity, because that happens. I may be biased. They may look like me and act like me, and oh, they're great. I like them. So you look for these moments of integrity. So once we have a good sense that they have a good character, it really gives you. So talk about moment of integrity. Dave Gold, who was the founder of 99-cent only stores, which is a dollar retailer based out of Los Angeles, unfortunately died about a week and a half ago. I remember reading articles about Dave, and one of them, I run into this negative article saying the SEC was investigating him because he had bought back a business from 99 that 99 had acquired 2 years before. And the SEC was basically accusing him of self-dealing, as well as shareholders saying, hey, you're buying this cash cow from the company and putting it in your pocket. So I kept reading the articles, and I learned 2 years later that what had happened is that Dave bought this business because it was a mistake, and he bought it back from the company. And he paid 2 times what they had paid for it, because during the time it had sustained operating losses. But Dave felt so bad for the shareholder, he really did, that he bought back this mistake, and because it was his idea to make this acquisition. And it's like, you run into something like that, you don't need to know more with that kind of action. They have integrity. Now, if you don't see those actions, it gets a lot more difficult, and you gotta, sometimes you have to wait. If capital allocation is important to the business, you have to define, what's very important to this business. And say it's a spinoff, and it's a new CEO and the capital allocation decisions were made at the conglomerate level. Well, you have to wait to answer that question, and maybe you don't invest as much. Maybe you kind of wait for certain information again, if it's a very capital intensive business and that's very important to that business to create value in the future, then you just wait. And so in those cases, we just wait to see a track record, like how are they allocating capital? Because if we go and assume that they're good capital allocators without any track record, that's when we make a mistake. So that's kind of what we're trying to answer is depending on every business has certain things that are very important to it. That you have to kind of figure out, what that is, and then just see if you see a track record or evidence to ask, to stand by your thesis.
What would you say are the key misuses of checklists? Where a lot of investors now have heard of checklists, perhaps use some element in their process, or others are continually, expanding the use of checklists in their thinking and research process. What do you think are the misuses?
It comes back to purpose. What is the purpose of this thing? And the purpose of investing is understanding how the cash flows can change. And if you're asking a question of a company and it's not relevant, again, it goes back to just blindly asking, does it have a competitive advantage, or and spending a lot of time, trying to determine whether it does or doesn't. And you need to ask, well, is it really important, for this business to have a competitive advantage? In some cases it may not be as important to the thesis. So the misuses are really just not really using them to gain knowledge about how earnings will change in the future, and really having that at the back of your mind, and not having a forward-looking mentality as you're answering the questions is a misuse. So for example, answering, what's the return on capital of the business? Just going and calculating that the return on capital has been, say, 20% for the last 20 years. Well, that can change. A lot changes in the future. And so, something that we've been using in the last few years for forward-looking mentality is that we try to, we envision ourselves writing an article, 3 years from now about our investment. And we write 2 articles. One is our thesis, what we think is going to happen. The other article is the counter thesis, basically the opposite of what we think will happen. And so this kind of forces us to think, one, in a more probabilistic way, in a wider scenario type, because, one of my biggest lessons has been that things are not a straight line, right? I used to think, well, earnings will go from $2 to $4 dollars a share in the next 3 to 5 years. Well, they go $2 to $1, to 50 cents, and if it's a high operating leverage business, then maybe back to 3 and maybe 350. So the pathway is a lot different. So we try to kind of see, as we're writing, say, these 2 articles that are kind of competing, we try to see as the business starts reporting, where does it fit in that? Which direction is it going? Is it going towards our thesis, or is it going towards the counter thesis? So as information is disclosed. So I think the purpose is really, you have to be careful to really not be using it too much to look at the historical account. Sometimes management changes, and at that point it becomes very difficult to use it just to look at the history, because again, a new management team, depending on the type of business, has a profound effect. If you're in retail, retail's a business you have to succeed at almost daily. It's a very difficult business, very management intensive business, and you can see management mistakes a lot quicker there than, say, a beer, Anheuser-Busch. There you could mismanage it for a long time, or Coca-Cola for a while. So, the misuses is just really putting things in perspective, and not just trying to understand the history of the company. And the history of the company will matter more if it's the same management team, and just really being more practical about that.
I guess in that context, it's not about the mechanics of it, right? It's not about, there's no secret recipe, so... the writing, and you mentioned the two types of articles that you write.
Yeah.
I'm curious, just more conceptually, how even the art of writing something down,
Yeah.
or I should say the practice of doing it rather than the art of it.
Yeah.
How important is that in your investment process? To not just think about something in your head, but to write it down, and what do you write down, and how often? How important is writing?
To me, writing, now I hated English in college. I hated writing, I'm not going to lie. But as I started writing quarterly letters, it's the most important thing, because when you're writing, you know, what's in your head and versus what's you're writing is completely different, you know, and so to me, writing is super important. And what we do is maybe I can talk about how you answer the questions on the checklist. You know, we try not to put any personal assumptions. So what we're doing is maybe we're quoting a source, you know, like an article written about the business. If we're answering a question like on, for example, on the integrity of management, you know, that I spoke about earlier. You know, we're sourcing the example, and so that's kind of what we're doing. Is we're basically using what we call either evidence or track record. You know, evidence is, for example, a story I like to tell is I was investing in Baldor Electric, which is an electric motor manufacturer based in Fort Smith, Arkansas. And the CEO invited me to a customer event where they were launching a new product, and I went down there and I was talking, you know, asking about pricing power. I said, "Does your business have pricing power?" And the customer said yes. You know, yes, they increased prices. The distributor said yes. And later I learned it was like 5% of the products had pricing power. And I started thinking, you know, I don't think these people are trying to deceive me. And so the answer, actually, the evidence is actually in the 10K. It's in the management discussion analysis section. If you look at the changes in gross profit, that's where it is. You know, they'll tell you we increased prices, it generated this X amount of gross profit dollars, and or increase the gross profit margin by this amount. So actually, that's the evidence. It's right there. Now, if it's not there, then we just don't know. You know, if a business has pricing, we just basically say we don't answer it. So, you know, track record is more like the management competence, you know, like, you know, are they good capital allocators? So if we're looking at Western Union, under First Data as an example, they were not, there wasn't a track record that we can look at because the capital allocation decisions were done at the First Data level. And so, you know, we have to wait, you know, to answer that, and then we answer it with a track record. But the writing is very important because the checklist becomes a written report. And it's a great feedback mechanism because you can, if you think about, you know, investing, we're basically in the business of thinking, right? And our output is a decision, an investment decision. So anything that makes your investment decision-making process better is just very helpful. So for example, one of the areas that I continually underestimated, looking back, you know, at my written record, was operating leverage, the degree of operating leverage. So in other words, you know, what impact on a high fixed cost business did a change in revenues have on the bottom line? So looking back, I would say, well, if revenues decrease 10%, you know, the operating income will drop 20%. And in reality, it dropped 60, you know, or 70%. And so I kind of started saying, you know, trying to learn why was it that I continually made this mistake? And how do I calculate the fixed costs of a business, and what and especially now, you know, again, it's good to have that question there, especially with the fixed cost business. It's at the top of my list, you know, as far as reviewing that. So by having that written report, that's really what it should serve, and it should be answered with evidence. So conference call archives, you know, looking back at conference calls on how management is answering questions, we'll quote management to answer a certain question, you know, and kind of source that document. And so it really is not about, I think the biggest mistake is people will go through the questions, you know, they'll go read a lot of 10Ks, they'll read articles, whatever they do, and then they start answering the questions, you know, and they just kind of write them in their personal assumptions are entering in this process, you know, like the pricing power example, or you may say it has a competitive advantage, or it may not, you know, or the industry may be growing or not growing. So you have to cite actual facts, evidence, track record to be answering these things rather than this personal assumption. That's where most people, I think, make the mistake, is because you really just can't be answering these questions from, just after reading a bunch of stuff. You really have to start quoting it from different sources and finding that what I would call like the first source, the customer mouth, whatever they're saying.
Now, can you give us perhaps just some insight into when it comes to, let's say, a new company, and you mentioned your database, so you're familiar with most of the names that you would look at depending on the price movement, let's say. But if it were a new company and you don't know what it does and you hear it for the first time, but you're interested in it for whatever reason, somebody, let's say, said something interesting about it, or you came on it on a screen. Give us a sense on a practical level how you go about the research process.
Okay, so we're big into management, so we start there. So we look at the proxy, and we look at their biography, and we just start immediately looking at what positions did the CEO have, before this. How did they rise? What are they a product focused, CEO? If you think of Steve Jobs, he's the epitome of product focus. Are they a sales-oriented CEO? Is most of their life in the corporate suite? So we try to determine, well, what is this business? If it's an operations-oriented business, we're definitely going to want, somebody who's come up the ranks through operations. So if you look at Dr. Pepper Snapple, Larry Young, the current CEO, and we looked back to 1969 through articles, but initially, like you're saying, we looked at the proxy to kind of. We learned that he was running Pepsi, and he was COO, and he ran bottling plants, and it was all there in the biography. So it's like that gives us greater comfort to take the next step. But we were looking at Cisco, the food distributor. Food distributor operations are key, right? I mean, you're delivering food to restaurants every day and to other places. And we learned that the CEO used to be CFO, and prior to that was treasurer, and most of his life has been spent in a corporate suite. So for us, we would pass, on Cisco, because we said this is an operations-intensive business run by a CEO who's spent the majority of their time in the corporate suite and probably be making decisions from the corporate suite and probably be doing things, emphasizing things like mergers and acquisitions, rather than operational efficiency. So that's kind of the first place. We look at the compensation differences. We try to see, is this a team-based environment, or is this one with an autocratic CEO? So for example, if you look at the proxy statement of Whole Foods Market, Expeditors, Fastenal, some of these great compounding companies over 20 years, the salary differences amongst the top 5 executive officers are very similar. So it implies this is a team-based environment. If you look at, always pick on Bob Nardelli at Home Depot, he's making 100, 200 times what the next executive. It's a very autocratically run type business. So we're getting a feel for the management, simply by looking at the proxies. And we'll go to the website, look under the employees tab, to see if there's a culture at this business, as I mentioned earlier. We quickly read the shareholder letter, and then we always get now the 2008, 2009 conference call archives if they've been at this business, because that was a very difficult time, and it's very revealing. It's like we're reading through these to see what kind of person are we partnering with. Is it somebody who's very open about what's going on and how they're going to deal with the situations, or is it somebody who we just don't understand what they're saying? They're just talking in corporate jargon. Or a positive side is hey, we're trying not to fire anybody, and we're cutting our 401k plan, and that you get that information in these conference call archives. So that's the other place we look for, and so for us, management's very important. That's where we start, our process, and we can kind of quickly pass on investments that just don't meet our criteria. So I think to help other investors, you have to have a sense of what your niche is. So an investment manager I admire a lot, his niche is in kind of busted retailers, microcap retailers, and he buys them for 1 to 2 times earnings. Sometimes I can't even believe he can buy companies for that amount, but he is very disciplined in waiting for them, and that's his niche. And so he kind of sticks. In other words, when you have a strong criteria, you know what you're looking for. I used to call it like the perfect spouse theory. That if the better your spouse, less looking around you're going to do, right? And a lot easier it's going to be to discard other, people. Like, if you're with a great person and all that, you're not gonna like the bimbo blonde. But if you have the bimbo blonde next to you on your shoulder, well, then a lot of girls are gonna look appealing to you. So that's kind of it's really important to have this criteria and understand what your niche is in investing, and it takes time to develop. I'd say in the last 5 years we've been more management focused because that's where we've been more successful, looking for compound machine type companies, and you have to have a great management team. So some people look at distressed opportunities and their maybe assets, understanding the value of the assets becomes a lot more important. So it's really tweaking that checklist to understanding in your area. But that's kind of how we take a quick pass on the company, using data that's available to anybody out there.
But you go to the point where, let's say, if there is a red flag in terms of the CEO, manager, and one of those red flags could be how they, let's say, dealt with 2008-09.
Correct. Yeah. I mean, if you see that they're just saying, hey, we don't know what's going on, or they're quickly reacting to news, like a lot of companies immediately announce layoffs, and they really didn't. What companies don't realize with layoffs are very easy to do. Cost cutting is very easy to do, right? But when things turn and you've gotten rid of, and when you start announcing layoffs, the good people leave first. I've been involved in companies privately, and they see the writing on the wall. The most talented executives and employees always see the writing on the wall first, and they leave. And they have alternatives, because they're talented. And so, if I see some CEO that's quickly just having a knee-jerk reaction, and they don't need to, well, that's definitely a red flag. Something that we would pass on the investment.
And then you don't even get to the other parts of the checklist about valuation and so on, because that is really your niche and that's what you look for. So if it doesn't pass those criteria, you leave it aside.
Correct, and I think going back to this, in the past, we used to look at the balance of factors making up for the negative, like, well, this is a great business model, recurring cash flows, high returns on capital, but, and just say, well, the management teams, they're okay, they're not great, they're not bad, and in those investments, we ended up not making any money, because it no matter how great your competitive advantage is, companies don't run themselves, it's very, I think that's one area that analysts don't spend enough time on, is understanding management. They just assume that the competitive moat runs the business, and it's true in certain business. Coca-Cola is going to be very hard to displace. It's had a series of revolving door of bad CEOs. If you look at how many CEOs they've had, and not a lot of value has been created. So you can have this great moat, great return on capital, everything meets, but if you don't have somebody catalyzing the value, and creating an environment where employees really thrive, then you're not really going to be creating a lot of value. So, for us, yes, I think using a criteria, and once you find something that does not meet your criteria, because if you start letting inferior ideas in, then your perfect spouse, in our case, we may have 10 spouses, 10 investments, or 20 spouses, the more inferior ones that come in, they start lowering the bar for the next one. It just happens innately, so it's very important to be very strict in your criteria, I believe.
So in a way, there are investors out there who will say anything at a price. In what you do, you really focus on getting the right value side of the equation, and that has to be right, and then you look at price as sort of a secondary.
Well, price, one thing that I've learned, with value is the biggest mistakes I've made, is you just kind of wait till a company really has a lot of problems, like fundamental issues, and that's where you're gonna, so I guess I'll backtrack, like thinking through a negative scenario, that a company, so you're buying a company and things are okay, and you kind of say, oh, this is my worst case scenario. You really don't know until it's there, and so what we wait for is for a company to have fundamental issues, a loss of customers, a cyclical drop in demand, something that's what's producing the value, and the lower price. But the mistake we've made is, say, buying Western Union when everything is fine, and paying a somewhat high multiple, and saying, well, they've got a lot of growth prospects, and then being wrong on that. So the price really comes always from something fundamental to the company, that really is where investors think that, this company's toast. So, as far, I hope I'm answering your question, but.
Well, let's talk
Yeah.
perhaps
Okay.
about an example
Sure.
then. If you look at your portfolio currently, what's a good investment in terms of exemplifying your approach, and perhaps you can walk us through how you generated the idea, and I assume management played a big
Sure.
role again, so give us a sense of that aspect and then how it really made it into the portfolio and
Okay.
how you...
So Strayer Education is a for-profit school, and the whole sector has just been decimated. I mean, it's one of the worst performing, that's a great place to look, right? Whatever's not performing well. And so we have a very high management criteria. So when we went in looking at that sector initially, the CEOs at the other companies deserve the reputations. But Strayer stood out because Bob Silberman, who's their CEO, to me, it's the best shareholder letter I've ever read. It is, one, he starts off by telling you, this is how we make money. This is, very simply, he explains to you in the most simplistic terms what his business is about, where his revenue sources are. 70% comes from federal aid, 20% comes from corporate, where a corporation pays for a student to attend the school, 10% comes from, their own pocket. And he's just, and then we pay teacher salaries and to have, and then for us to administer the company. But when we were reading his shareholder letter, he was talking about the problems they had, such as, back then it was about not letting any student in. So we saw discipline. He was very disciplined and not, like for example, he used to criticize the practices of the other for-profit schools that's got them all in trouble right now, which is they would pay sales commissions to their recruiters, on the number of students they brought in. And so you'd hear, and surprisingly, Kaplan, owned by Washington Post, was one of the worst, where they were taking bums off the street and enrolling them in the college to get the federal, money. And Strayer doesn't pay commissions to its recruiters. They're paid a straight salary. They've never done that. Second thing we saw with Strayer is that they actually have two dual structures. So basically they have the academic side. So they manage it. It's almost like they have the academic side, they have the profit side. And so the academic side makes decisions on what is important from the academic standpoint. Because what will happen is there'll be a class that's not profitable, but it's very important for the education of that student. And so the academic side says this is a required class, but if it was the profit side making the decision, they'd say, absolutely not. We're not going to be investing in this. So for example, Strayer has invested in making sure that their new students have good math standards and writing standards, and so they invest in tutoring, to bring students up to speed. But we saw this discipline, and we're seeing it today. As the stock has been dropping, it's now trading for about 5 times enterprise value to cash flow, or free cash flow, which is just a crazy valuation. But they have a lot of headwinds, and so we like to see it. We like Bob Silberman, and we like the model. The school, it's a high return on capital business. Today they're earning 20% operating margins, and that's worst case. The other thing is they're living their worst case scenario. Basically, they've had a big drop in the number of students. They've gone from 55,000 to, I think it's 46,000 today. And it's a high fixed cost business, so little changes in the revenue have profound impacts on the bottom line. So that their earnings, they were supposed to earn $11 or $12 a share today, and they're earning $5.50. It dropped earnings by half. But the value came where we saw that, initially we started buying because the government went after the industry. They were basically clamping down on their practices. And for some reason the government the schools don't have the same, they don't report the same numbers, such as retention. In other words, if they report a student retention, the way each school calculates it is completely different. So there's no standardized system. And Strayer kind of got caught as one of the worst companies, by these new standards. The government said that you have to meet these standards to get Title IV loans, which is basically, and so that's why the stock first started going down. And then you had these fundamental issues where you've had these high levels of unemployment, what they call real unemployment, and that has contributed to this decrease in demand. So, we kept buying the stock from over 100, now it's down to 45, and bought some today, in fact. And so we just keep buying it on its way down, just because we believe these issues are cyclical and that they will turn. And just like the drops in revenue had a big, profound effect on the bottom line, that when things start improving, they're going to multiply. The other thing is that Silverman is actually a very good capital allocator because he is removed from the day-to-day operations of the business. So one thing that's interesting about capital allocation is if you are an operator of a business, CEO, I have found that all operators are not good capital allocators. I mean, you're really judging the degree of incompetence, as far as capital allocation, because the best capital allocators remove from day to day. They're like Warren Buffett. There's a book called The Outsiders that's recent that Buffett recommended. The key theme is all these people. Henry Singleton worked alone in the office. Tom Murphy, they were not involved in day-to-day operations. So at Strayer, actually, Silverman is now executive chairman and is not involved in the day-to-day, decision making on the courses that are offered. And so he sees a big picture. So while we're in this downturn, he's been buying back stock. He bought 5% this last quarter, 5% the previous quarter. In the last 3 years, they've taken it from 14 million shares to about 10.8 million shares today. So he's been very active in taking advantage of this low stock price. So we see that as kind of as a bottom, in that he's creating value for us on that end. But the most important thing is that he will not budge on the student he admits. So they're very strict about the type of student they admit. One, they have to have a high school education. The other schools, they now are forced to use that, but he's always had that criteria. And they also have to pass some remedial standards. And it's very tempting for a CEO to lower the standards when you're losing so many students to fill the class. And he will not budge on this one thing. He says it's got to be the student we're looking for that fits best, because he, as he's explained, one bad student ruins a class, and anybody who's been in college knows that, that's true. You get a couple of bad students in the classroom, it really could ruin the course. They get combated with the professor, and it's a distraction. And so he's very, very disciplined in making sure that his university has a high quality student, because to him, as he says, it's the quality of his customer determines the value of that school. If he's graduating the wrong people, then that's not going to build value over the long term. And so these are the actions that we've got very interested in the company. Furthermore, it's got a lot of growth prospects. They're only halfway through their nationwide expansion plan. And what's interesting in the way they expand is one of the most disciplined growth companies, because what they do is they wait to see how many academic or deans they have available to open a campus. So first they see what is their human talent that's available. Then once they ascertain, how many people can open campuses, that's what determines their growth rate. So if we have, 5 deans, that can open up college and people that are under them, academic advisors and so forth, then they'll open that number of campuses. If it's 10, they'll open 10. And they also grow organically, geographically, so they're not going from New York, say, to California. They're growing state by state because they like to borrow people from the closest geography to them. And so this way there's less execution issues, because say you have issues in your college in Texas, well, you can take people from Louisiana, to kind of help that have been in this, maybe operating their school for 3 or 4 years, and then you've got new people in Texas. They borrow from those people, so it's a more discipline. So for us, we see, this is cyclical. The stock is super cheap, and we're basing our free cash flows on today's free cash flows, which are distressed free cash flows. These would not be your normalized, and so that's why we're buying with more conviction. Now, the biggest risk is the length of time it takes for the employment picture to improve and for the number of students to start enrolling again. The longer it takes, the longer it's going to take, for those earnings to come back. And so, that's basically what we see as the biggest risk. But we sleep well at night knowing we're partnered with that type of management that's going to be making the right long-term decisions, making these great capital allocation decisions. I mean, I can see them buying at least 30% of the stock over the next couple of years easily. And that'll, when things turn, it's going to have that double whammy of, increased earnings but off a lower share base. And so we're just patiently waiting. And just as long as we see that they're not sacrificing academic quality, that, to try to get more students in, or we're looking for those variables. That's very important to us. Then we're comfortable in the investment.
So it's very interesting. I would say quite a few value investors have also recognized the opportunity represented by for-profit education. It's definitely out of favor, so a good place to look, as you said.
Yeah.
But some have adopted a basket approach. They're not really sure. But
Yeah.
you seem to have really placed a lot of importance, and goes back to your approach,
Yeah.
focusing on management, on who is the best of breed in the space, and then making a concentrated bet. I assume you don't own any other for-profit.
I think the others have structural problems. Strayer is more cyclical. And what I mean by structural is if your business practice in the past was to pay commissions to your recruiters or to accept inferior students that didn't belong there, it's very difficult for them to the government has imposed regulations on them, and so they're forced, now they can't pay commissions. But it's very hard for all of a sudden for them to have a new culture, overnight. And so I wouldn't sleep as well owning the others. And frankly, a lot of the management teams, I hate to say it, but you feel like showering after meeting with them. They're very sleazy. They're very. I mean, it's a good business. The returns on capital are extremely high. The margins are high. I mean, it's a great business. I mean, it's basically a university without the fixed cost of the university or the tenure. And so it's very tempting, the leverage is very tempting to just focus on the money, on the profits. And that's what, so the other schools, and DeVry would be an exception. They've run on a different model. But the other schools are facing more structural. They've had to change their business practices overnight. So they have more issues, in my opinion, to get out from this, because they really have created a lot of bad will with students, and so a lot of the decisions that were made 3 years ago, they're paying for today, and they're going to continue to pay for them. So it's one thing we looked at is Senator Harkin went after this industry in a very hard way, and the Department of Education as well. And they published a very big study on all these schools, that's publicly available, where they commended Strayer, basically on their practices, and they looked at things like debt to income, where you're basically saddling your students with too much debt. That they couldn't afford it, promising them employment. For example, Strayer is very stringent about not letting you enroll unless you're employed. In fact, I think it's like 95% of their students are employed. The other schools, they would take somebody that was unemployed and basically promise them, well, if you get this education, you'll be making 5 times what you're making today. And that's why I have avoided the others. But I don't see anything wrong in what the others are doing. I mean, it's not a business that's going away. There's still a big need for it. The reason the whole industry was created is because traditional colleges cannot. The working adult student is a completely different student than an undergrad or even regular graduate student. It's just a completely different model. And traditional universities have not, even though they're getting in the business, and I've been following this industry for a decade. I've seen them come in and out, and they try it and they get a little traction, and then it ends up failing because traditional universities have a 10-year system, where professors are able to say who's hired and who's not hired, and so there's a lot of politics involved that the for-profits don't have. So, it's not an industry that's really going away. It's just, to me, I would rather invest in a business that has a cyclical issue rather than is dealing with structural issues that are more headwinds. Bridgepoint's another company that is private equity backed, and so they really just chase the profits. They didn't really care about the quality of the academics. And if you're doing that, if you're running your business that way, corporations send a lot of their students. That's a great referral network, is corporations sending their employees to be trained. Because they need, in order to be promoted, say if you're at FedEx, you want to be promoted, and you don't have a college degree, it's a requirement. I mean, so that's why this business exists. So if they're sending their students to University of Phoenix and they're not coming in prepared, and they're sending them to Strayer or others, eventually they stop sending, less and less, and they send more and more to the other schools. So that's why I worry more about the other schools. I think they're just more structural issues. And the CEOs are frankly, they're new CEOs. One used to be a stock analyst, the one who runs Apollo. It's not like it'd be like me running a company. I'd destroy it quite quickly. I don't have the experience, as an analyst versus an operating CEO that deals with people. I don't, and so that's kind of why we passed on the others. But
and is that perhaps one of the key insights tying this discussion back to what we talked about earlier in terms of the checklist? So for this type of business, for-profit education, management is a key.
Well, and it goes down to the quality of the student determines the value of the university. If Harvard, continually graduates, the future leaders. Now, how do you destroy Harvard? You start lowering the academic quality of who they're getting, or MIT. And so as soon as you start lowering those standards, you'll start destroying that reputation of that university. It's going to take a while. But so management is who enforces, they're the ones, if you have somebody like the Bridgepoint that are private equity mentality, they don't care. They just bring the students in. This is a great model. The more students we get, but the better. But that I guess that's what I'm pointing out. It's a little bit more short-term oriented, and they're not going to create value in the long run versus the others that, Strayer would be more long-term oriented. So over the long term, they'll create more value. So it's also a holding period. Now, if you're an opportunistic investor, I think the others might be fine. They might get so cheap, that. But Strayer's down there as far as cheap. They're trading at about the same level as a lot of these other schools. So for me, that was also a factor that said, well, if one was trading at 1 time's earnings or something, then of course I might be tempted to buy that as an opportunistic play. But for long-term investing, what I do, compound machine type investing, we like something with a long runway and something that's making the right decisions today that we're not going to pay for in the future.
Is there anything else in your portfolio that is a good example that perhaps you'd like to share with our audience?
Yeah, Brookfield Asset Management, I think, is so overlooked in our community, and we focus a lot on Berkshire. But the beauty of Brookfield is basically they own hydroelectric. It's basically an asset manager, and it has these 5 publicly traded entities that are pure plays in their industry. So one's a hydroelectric, a dam owner. So basically a dam, a piece of concrete on a river. The operating margins are like 70%. It's literally the lowest cost of electricity, and they get to sell their electricity at prices determined by coal or natural gas. So you're producing at the lowest cost, and you get to sell it, at a market that's determined by a higher cost commodity. So it's a recurring revenue, high free cash flow business. Now, their business suffers by rainfall, but there's a very low distribution of free cash flows. And this is the whole theme of Brookfield, is that he does not like cyclical businesses. Bruce does not. He invests in these businesses that have very stable free cash flows, and that they can slowly increase these free cash flows over time. So in their property, Brookfield Property, which is its own publicly traded entity, they focus on Class A space, say in New York, the World Financial Center type buildings, or 245 Park Avenue. They get the right addresses where they have pricing power, and they're very fair with rents, where they get the right client. They'd rather rent to KPMG, and I've seen them not rent to hedge fund managers, because they said, even though you're a $1 billion hedge fund manager, we'd rather, rent to KPMG. We don't know if you'll be around. So they're very selective, believe it or not, in their tenants. And then they have price increases, that they're always able to generate from these properties. So you have these stable free cash flows, and then you have this terrific, one of the best capital allocators out there, which is Bruce Flatt. And as far as, to say, how can I vouch for that? Well, look what he did back in 2008. He actually bought General Growth Properties, which ended up being one of the greatest real estate deals of all time. I think it's the most value ever created in the shortest period of time of any real estate deal. He ended up buying Babcock and Brown, which was a defunct Australian infrastructure company that had the largest coal terminal in the world in Australia, and also was buying terminals in England. So he likes to get into these asset classes at these very low prices, and he's very disciplined. So during the good times, he walks away from deals. So one of my favorite stories is he walked away from buying Canary Wharf because Morgan Stanley bid $1 more for the Canary Wharf project. These are the buildings in England. And he just simply walked away. And his philosophy is that we'll get it later, And on the real estate side, I remember I know a lot of the individuals that work at these subsidiaries, and they said it was very frustrating. They'd spend, say, weekends in a year analyzing Washington, D.C. properties. And, it'd get to a price where Bruce said, this is not the right price, and I'm walking away. And they're like, yeah, but I spent every weekend and time away from my family, and he has that discipline, where he's not emotionally invested in it, and he can see the big picture. And then later they were able to buy those properties for a discount, 2 years down the road. So he's very disciplined on capital allocation and making sure. And, he's in a business, everybody thinks it's too big, and frankly it's not. He's in a business where they're investing, billions, where they're able to put a lot of money to work in infrastructure type projects. Their infrastructure group has been that's another publicly traded entity. And so what's happening is, the reason I think it's a great company and a compound machine, which is what we look for. One, you have this great capital allocator. But what he's done is, at the Brookfield Asset Management level, he has these subsidiaries that are just sending, he's got basically captive funds, permanent capital. Each of these subsidiaries, and he gets an asset management fee for managing these separate entities. And it's permanent capital, it's not going away. And furthermore, he's got two sides to it. He's got the public side, but he also raises money from sovereign wealth funds and institutional customers. So that generates a fee income, where they're locking into these funds for 10, 15 years. So for example, they own 95% of the electricity transmission lines in Chile. And they own this, privately and public, and part of it in their public side. So they, it's just one of these businesses where you've got these super stable free cash flows. If you look at Berkshire, there's a lot of cyclical businesses at Berkshire, and Bruce, his philosophy is if you look at Berkshire again, a lot of these businesses, the cyclical businesses, the money they lose in the downturns offsets the gains later, and so in a way, over a decade, you've broken even, But if you are in these, super assets like hydroelectric dams or the property or some of these infrastructure projects that he's in, where he's got these long-term contracted cash flows. Like, for example, he entered wind, and only because he got a 20-year deal or 20-plus-year deal from the government in Canada, to buy electricity at a certain rate. Then you've got these stable cash flows, and then you can go and reinvest those in these opportunistic type deals. So basically, he takes advantage of people that get over leveraged, and he's continually scanning the globe looking for people that are, like right now in Europe. He's not buying European assets; he's buying the assets that the Europeans own in other countries. Because those are the first ones they discard. So, and he's a young guy; he's in his 40s. He just doesn't have kids. He's dead. He works 7 days a week. It's a very open culture. He's got not a cubicle, but just kind of a desk that's open with everyone else. This is not a non-hierarchical organization. He doesn't possess an ego from the standpoint that he's an empire builder, and he's certainly not out there giving interviews or he's very low key. So he's just quietly creating this compound machine, and he's got if you have these contracted stable cash flows, it allows you to do that, where you don't have these big surprises. I mean, in 2008, cash flows didn't change that much. The recession didn't change. The government was buying electricity from you for a certain rate. They still kept buying it. So it allows them to kind of really, in unstable times, take advantage of these situations. And now that it's more simplified, what happened is people avoided Brookfield. It's very complicated, to understand all these moving parts. They have a private equity fund, they have institutional money, and then they have these public entities. So he is now that he has spun off, it's called Brookfield Properties, BPY is a symbol. He's spinning off all the hard assets. It's an asset, Brookfield Asset Management, BAM, has now become an asset-light business. Basically, the great things that happen in asset-light businesses. So will have divested all of that. And it'll be a lot more simple structure for investors to understand it. And so I think as investors get more confidence, you'll start seeing the stock trading more towards intrinsic value, which they actually calculate for you, and they tell you how they calculate it. And they're saying right now the intrinsic value is around 44 a share, and the stock's maybe 36 or something like that. But it's got tremendous growth opportunities going forward.
What do you think is perhaps the biggest risk with that type of investment?
With Brookfield, it'd be losing Bruce, because he really is. It's almost like Buffett, losing Buffett at Berkshire. He really, like I gave you the example of the people I know that spent a lot of time, on that real estate deal. If it weren't for Bruce, they would have gone ahead and made that purchase. And so you lose that discipline going down. But as far as like the assets he's buying, he uses leverage very wisely. He could use way more leverage to generate higher returns, but the way he likes to use leverage is he tries to assume what's the worst case scenario for this. What could happen to these cash flows, and can we still make these payments? And he's very good at restructuring debt, making sure it's got longer payouts. He's doing these serial preferreds where they're paying 4.75% over the next 30 years. So he's on the business end, it's kind of hard to. I think the issue would be getting too big. They're raising a lot of money from institutional funds because as institutional funds are seeking yield and especially stable yield. So one thing with Brookfield, they used to have a hard time pitching institutional investors because they would promise, they say we'll get a 12% return, and their competitors were like, we'll get you 15 because they're using more leverage. And again, Bruce, super disciplined, would not budge on that. But the ones that were chasing the 15, believe it or not, started getting over leveraged. So I think as maybe if they raise too much capital, there's a risk that they have a need to put the money to work, and as there's a more appetite to invest in infrastructure, it might be tempting. But so far, in his track record, looking at his track record, he has shown incredible discipline about putting money to work and not just throwing it into any kind of deal. It's very hard to find mistakes that he's made. One was buying, I believe, some Australian real estate, or when they get into a new asset class, like in the ports, they just got into the ports business. There's a learning curve. One thing is that they're very operations oriented. So on the hydroelectric dam, they've done, I think it's 140 deals. That's an area they know well and they dominate, and they can evaluate a deal in a day. They know exactly what they're looking at. But when you get into ports, they have less experience managing it, so that anytime that happens, they're going to make a lot more mistakes on the operations end. But they're a learning organization, so they're not afraid to admit their mistakes, which is very important. There's really no egos at the business. These Canadians are all very low key, and they're just really like compounding. It's amazing. They really get a charge out of it, and they're very low key. Many are wealthy, and they don't work for money. Their lifestyles do not reflect what they earn or what they're worth. There's a lot of young people that are worth a lot of money, and frankly, they just continue coming to work and living in the same place and building value.
Now, you've shared some examples with us, as well as your approach to investing, the research process behind it. Tell us perhaps what is the most underutilized resource that you think investors should be perhaps paying more attention to in their research?
You mean like a source?
A source, yeah. Or even area of research, or a way of researching investments that you found very helpful, but is perhaps not as appreciated out there.
As a source Factiva, I just really don't know many investors that go and read historical articles about a business or management team. And it's so valuable because you're able to see how a business has grown over a period of time. You're able to see the risks they've encountered. If you're looking at a business today, you're just reading the 10K, you're looking at kind of recent events. But by looking at articles over a long period of time, you can kind of see how this business has grown and the challenges they've had, the headwinds or the tailwinds, the bad managers. Emphasize looking at management. If you look at the pharmaceutical industry, if you look back in the 80s, that's when they were creating the most value and they were coming up with the most drugs. And if you look at the CEOs, they were all product people. They were scientists, and people like Vagelos, at Merck. They were scientists. It's product development is what mattered to them. Over time, it transitioned to these sales-oriented and CFO types that came in, and so all of a sudden mergers and acquisitions became more important, acquiring somebody else's pipeline or bolstering the sales force as Pfizer did, but that's not creating any value. So the pharmaceutical industry has been a value trap, for a long time because of the management teams. So I think really looking for these product-oriented, who are you partnering with, not just integrity-wise, but what is their background? Are they really going to create a lot of value? Again, there's a blog, CEO blog now, social media. I was slow to pick up on that, but how they think. A lot of CEOs are now on blogs, and they're telling you how you get good insights. But I'd say that probably the most underutilized is Factiva. That should be, we got rid of a lot of our services that were more quantitative, like CapIQ and FactSet, which we used to use, and have really just kind of turned to Factiva and LexisNexis. Just really, and you get better at searching, through articles. Another thing is through 10K Wizard. For us, culture is important, so we'll just put in a search term such as culture and see what 10Ks it pulls up. And a lot of times we can, so when you can use search terms through 10K Wizard to kind of search through something that's important to you, or what you're looking for in your area of expertise. So I think that might be underutilized, but I'd really say reading historical articles. I just never see it really done, and it's like, wow, I can answer so many questions on this checklist quite quickly reading through it. Conference call archives too, not just 2008, 2009, but figure out where that company had a difficult period, and then read those conference call archives, and you get so much insight about who you're partnered with. Are they giving you generic answers, like I said earlier, or are they explaining clearly, like, what, we don't know what's going on, like we don't know where it's going to head, but this is what we can control. This is what's under our control, and this is what we're doing about it, and they kind of have a clear plan. I think investors also look at, one thing is we like CEOs that don't announce strategic plans. So to us, Ron Johnson at JCPenney was very obvious because here's this master retailer that came from Apple, and he starts announcing changes immediately. So one thing is, like, whenever you have a CEO who comes into a business from another business and starts announcing changes quickly, the writing's pretty much on the wall, because the best CEOs, if you look at the best turnarounds, like Sturm Ruger, the gun manufacturer's one, they've had some tailwinds, but also they've done a phenomenal job on the product side. When that CEO came in, he actually didn't announce anything for a year. He spent his time going to the gun dealers and understanding, what is wrong? Why aren't our guns selling? Talking to customers, over the counter, just going, how come you're buying Smith & Wesson and you're not buying our company? And they tell him, and then he started meeting with all the employees and getting to know, like, who he had to work with, So it's easy to have a vision in your head and how it should be executed, but if you don't have the employees buy into it, or they don't have the capability, then it's not going to work. You're going to run into a big problem. So when Ron Johnson came in, we said he got rid of discounting. We knew that the core customer, viewing it from the customer viewpoint, liked the discounting. I mean, this is why they went to JCPenney, and he got rid of that. Circuit City is another example. When their CEO came in, before it went into bankruptcy, he looked at the financials, and he looked at the SG&A side, and because Circuit City used to pay commissions to the sales floor people. Best Buy didn't, but Circuit City did, and that was their advantage. They became more knowledgeable, and he got rid of it. You can look at Nardelli when he came into Home Depot. First thing he said was, get rid of this plumber, that's working in the plumbing department, a retired plumber, and replace him with a young student that doesn't know anything about plumbing. And so I think, getting too attached to somebody who's announcing a strategic plan rather than somebody who is managing day to day, like, it's very exciting when somebody has a strategic, because it gives you a vision of what things could be, but they never end up working out that way, because a strategic plan kind of sets you on one pathway. Like, if it doesn't fit the plan, it's not going to fit, but you got to be able to be flexible, because things change. Tastes change. But if you have this, like I wrote in the book talking about GM, they had this, I think it was stickers of 29. They wanted to get 29% market share, and so that was the sole focus of this company. They started. That's when they came up with inferior products. Because. Like, it was the car that blew up, Yugo. Was it the Yugo or I forget it was one of those cars that blew up, because the gas tank was in the back. Well, they hurried because they were trying to get into a market, too quickly to meet this goal of 29. And so we also stay away. The other thing is I think investors focus too much on CEOs that just focus on shareholder value. And I hate using that, I'm going to sound like a hippie, but it's like focusing on love. You're not going to give love by focusing on love. You get love by focusing on compassion. You get love by being generous with people and giving your time and being genuine. So same thing goes with a company. You're not going to get profits unless you're focused on the customer needs. If you're not beating up your suppliers, maybe instead working with your supplier to come up with better products, to give to your customers. And so it's looking at a company more from a multiple stakeholder standpoint and seeing how good management is at managing, making sure that they're not sacrificing customer quality in order to get a higher profit. Making sure they're not, one of the big, I think Sam Walton is rolling around in his grave at how Walmart treats its suppliers. Because when Walton ran it, he was actually very good to the suppliers. It's a big misconception. He was very big about helping his suppliers create better products for his customers. And today it's become a culture of just cut to the lowest price. It's too focused in one direction. So looking at it more from a multiple stakeholder model, I think is something that has helped me at least. The way I used to do things. I don't mean to criticize people that do this because I was doing that, but when I have this more expansive view, it's helped me in investing.
Now, Michael, you mentioned several CEOs that are out there creating value, or they're great capital allocators and not just operators. The two are often, as you said, separate roles, and that's when it functions best. Tell us a bit about some of the perhaps lesser well-known but great capital allocators, great operators out there that you've come across.
One recently that IPO'd is a company called Guidewire Software, and it's Marcus Ryu, RYU. And basically Guidewire does software products for pricing for insurance companies, and specifically property and casualty. And what's interesting is this is a business, the property and casualty, where they still use green screens. So basically the green monitor, with the green letters, because they're dependent, insurance companies are dependent on these legacy systems. So Marcus actually, before he started Guidewire, came up with what the ideal software company would look like. And then he went and looked for a problem to apply it. And he focused on property and casualty because he said this is the area that you have the biggest problem. I mean, they're still on these legacy systems, there's inefficiencies, they have these old printers, at the State Farm agent. So he started to attack this problem. And furthermore, interestingly, today Guidewire is actually the #1 place to work in Silicon Valley. You'd think and I guess it depends on which survey you get, but this is the San Jose Business Journal. And the reason is because their software engineers and developers work less, because Marcus also attacked the problem of why do software engineers work 80 hours a week? And a lot of it had to do with miscommunication, is what he discovered. And so basically the coder, they send somebody, I guess a software engineer will go and visit the customer and say, what do you want? And then they'll go back to the coder and they'll say, this is what the customer wanted. But there was a loss of communication in between him and the coder. And so when they went back to the customer said, this is not what I want. And so Marcus just said, well, just send the coder. But the coder doesn't like meeting with the customer, but still, send the coder, or send the people that are in that area. And so it's a great place to work because it's a work-life balance. You're not working 80 hours a week because he found a more efficient way. They're super customer-oriented. The other thing is most software companies lie to their customers. They're always on development time. It'll take a year. And Marcus says, we're not going to lie. Basically our competitor's going to go in there and say they're going to do it in a year. We're going to tell them the truth. It's going to take a year and a half, 2 years. And they lost customers, as a result of this. And a lot of those customers, interestingly, today are now going to Guidewire because they've had bad experiences with his competitors. But he's got a super long growth ramp. And here's somebody who just very intelligently thought about the problems. Charlie Munger talks about that. He started with the problem first and then created a company around a solution, basically how to make these businesses more efficient and how to get them out away from these legacy systems. And he's been very successful in getting large insurers to now start transferring to a software platform, which has been something that everybody said was impossible at the time. He's just very focused on the customer. Another is Robert Keane at Vistaprint. Vistaprint, basically, you may have seen the ads. They print business cards and other things for micro businesses or micro, what he calls micro, which is 1 to 3 people businesses. Interestingly, he won't go after customers or 5 small business, which is maybe 10 to 15. He actually doesn't go after that customer. He sticks to micro. And here's a CEO that manages the business for the long term. He made a decision about a year ago. They've always had a 10% net profit margin. It's been a very, you wouldn't think business card printing would be such a profitable endeavor, but he decided to actually cut that margin in half in order to invest more in customer support and also in marketing, getting the word out about Vistaprint, because now it's about $1 billion in sales, and so the more the sales are, the bigger the economies of scale, which is the advantage here that he's trying to build. But Robert is just the epitome of continuous improvement. In other words, as far as like the number of minutes that somebody touches a business card in the process of printing out the business cards, he's always got these metrics where he's lowering it from, say, it used to take 50 seconds to now it's 7 seconds. And he has all these engineers in Switzerland working on these problems to continually make it a more efficient process while not sacrificing the product quality. Keane is just very focused on the long term, and one area that he actually took a hit with customers that I liked is they used to have these ads where they'd say, you can get this product for $5, but it's typically $20, and so it was a discounting type technique that generated a lot of impulse buys. People didn't want to pass up on this limited opportunity, and Keane, it was very profitable for the business to do this, but short-term profits. So Keane got rid of this practice, because he wanted to build a more long-term relationship. He saw that retaining his customer was a lot more important than turning these customers. So, a CEO who's willing to abandon a very profitable long-term business practice for one that builds more value over the long term is always a great sign. So those are 2 that come to mind at this juncture.
Well, Michael, you've been very generous with your time. I just want to ask you if there is anything we haven't discussed when it comes to the art of in-depth research that you think is really important.
It's just going back to how we started. You just not, like I said, I used to do too much in-depth research, and just, but I think that's okay if you're starting off. Not to be afraid of that. When I first started, somebody paid me to analyze one company for it was about 8 months. One company, that's it. 8 months. That's all I did, night and day. And of course, I was young and out of college and wanted to impress, so I worked extra hours. But that taught me, to really, I got to the point where I'd interviewed pretty much every customer. It was Nielsen Media Research, which was a ratings company that was being spun off at the time. I talked to every single customer that bought that service, and they had a competitor at that time called SRI Research that these same customers were funding. And, talking to the customers, I realized they said, this is not a real thing, this is just a negotiating ploy. Basically, it's worth our money to create a competitor which won't have legs to get better ratings, basically more ratings for, more homes and force Nielsen to do that. So just really taking the time to understand a business and not being impulsive. Like I used to buy stocks if I saw an investment manager I admired by them. And, I'd get tunnel vision and just immediately buy it. And it was an impulse buy, And you start learning that really it's about 20% of an investment manager's holdings that create all the value. So your odds are already stacked against you. It's 1 in 5 that you're going to get it right on that investment. So, really taking the time to understand what you buy so you're in a position to understand, what you own and you can make decisions. And that's where, as far as like we talked about doing too much, if you really understand value, you make decisions, and the decisions are a lot easier. You know when to buy, you know when it's cheap. When I knew everything about Nielsen, I knew so much. Every time I'd read a news announcement, I'd laugh. If it was about, SRI, the new competitor, is going to put them out of business, I said, no way. This is so. By doing that in-depth knowledge, and then, again, understanding a business from a customer perspective and not your own. And where this helped is, for example, when I first started analyzing Whole Foods market, the grocer, I thought it was an overpriced discretionary grocery store. That was my viewpoint, because I shop the store once a month, maybe once every 2 months. And but I took the time to understand the customer viewpoint. So what I started is Whole Foods is a very decentralized business run in different regions. So each region runs. And I said, if I talk to each regional president and ask them, hey, what is the core customer of Whole Foods? Just help me, how would I go about answering that? And I approached them and talk to the West Coast, talk to East Coast, and you get a consistency of answers. And one, it was an educated consumer, and I was thinking to myself, wow, I only go once a month. What's that say about my education, Second, I learned that 20% of their customers made up over 80% of their sales. This is a shopper that did not shop at any grocery. They shop exclusively at Whole Foods. So with that, I went to stores, started talking to store managers. I wouldn't prompt them and say, hey, I hear 20% make it, I'd ask them the same question and see if I got a consistent answer. And then I'd ask them to just point out customers, like, who is a core shopper here? Is it that hippie? No, you're wrong, it's that lady with the little teacup poodle that's well-dressed. I said, well, I thought this was more organic hippie, and no, it's her. And I talked to her, why aren't you going to Safeway or Kroger? So I understood this business from their viewpoint. So we started buying Whole Foods at about $40 a share back in 2007. 2008 comes along, all the stocks drop, but Whole Foods drops to about $8 a share, way more than everything else. And what had happened is, for the first time in 25 years, they had negative same-store sales. And so the analyst, Wall Street analyst, jumped on this and said, this is a overpriced discretionary grocery store, and we're entering a recession, maybe a depression, and since it's overpriced and discretionary, customers are going to abandon it in droves, and that's why the stock dropped more. We kept buying with conviction because we understood it from the customer perspective, and not my perspective, because my perspective was the same as Wall Street analysts, overpriced discretionary store. But by understanding from that customer perspective that they would not abandon this company, I could buy with conviction. If not, then you're fooling yourself, and so I think that's very important. That's one of the most overlooked areas.
Well, with that, Michael, I want to thank you so much for your time and sharing all of your insights with our audience today.